Let's talk about how to handle earnings season in the midst of political upheaval. Sam Stovall joins us, Chief Investment Strategist at CFRA. Sam, great to have you back this afternoon.
Happy to talk to you again, Oliver.
Appreciate that. Okay, so let's start with what happened over the weekend. I guess we don't have any historical precedent for that, do we?
Well, not really. I mean, I guess you could say that in 1968, March, you had Lyndon Johnson say that he wants to focus on the Vietnam War and the matters at hand. And as a result, I will not seek and I will not accept the nomination of my party as the president of the United States. So in a sense, that's what President Biden just did. However,
it's a little later in the game.
Humphrey took over.
And yeah, exactly. Not much time left, right?
Not much time left, but it was a very, very close race that Nixon tended to squeak out. So we'll see what happens this time around. Also, coincidentally, the Democratic convention was held in Chicago back then.
Ah, I love that. See, you've always got the historical stuff up for me. Even when I thought there wasn't some. All right, so that becomes a pretty big event for markets. Or, Sam, do you think right now we're still too far away to be pricing things based on election outcomes? Do you think the market has been moving based on any of this?
I think it has been a bit because our Washington analysis, our political strategy arm, now brings the Trump victory down to about 65% from 75% or higher. Oh, wow. Now that Kamala Harris is to be the likely presidential nominee. I think investors are waiting to see whom she selects as vice presidential candidate. So there's a bit more energy and possibly a bit more upside for the Democrats. So it brings down the value of the dollar, brings down some of the worries of inflation and tariffs that would be coming from President Trump. But at the same time, you're not likely to be seeing any tax cuts if Harris becomes president. More tax increases for those people who make $400,000 or more.
So the basically last 2 weeks, we've had inflation, we had attempted assassination, and then we had resignation, or rather abdication or something. So with all that said, we had a rotation within markets, tried to go to like small cap stuff. That worked okay, but tech was too heavy, so the market basically went nowhere. S&P's now over the last 10 days slightly lower. Today pops us back up after the odds for Trump dropped down. I mean, it seems like basically it maybe doesn't matter, Sam. We went sideways for S&Ps. We were up with some of this stuff with Trump pricing in, and now we're down. We're up with it with his numbers down. Like, am I crazy?
Well, I think what it says is that the politics is headline, but you really want to focus on inflation and the Fed for the bottom line.
There we go.
And you can add in the NVIDIA and AI-related earnings because I think right now the market is basically saying, okay, semiconductors are likely to see about a 53% year-on-year increase in earnings this quarter, and for the full year of 2024, and another 40% on top of that in 2025. So expectations are still pretty high for the semiconductor space and for tech in general. And until that becomes disrupted, I think there will at least be support under the market and therefore allow for some rotation to continue into mid and small caps.
Fantastic. Very well said. So take me through those numbers again here, because it's going to be a couple of weeks until we really get the hardware semiconductor trade. But Tesla's been buying, or X, someone under Elon Musk's ownership has been buying NVIDIA chips. And Alphabet's been building out, of course, their AI capacity. So could we get some decent forecasting and maybe early cues this week?
I think we could. Certainly what we'll do is we'll get the second quarter results, even though that's ancient history by now. Expectations are for some guidance, and we're likely to see guidance, as I had mentioned, for 53% growth for the semiconductor space for 2024, 40% growth on top of that in 2025. Semiconductor equipment, not so great this year, up 3%, but up 31% in 2025. So technology itself is still expected to be the leader, not only in 2024, but also in 2025.
Yeah, those are incredible numbers. What about the stuff that the market tried to pivot into over the last week, Sam? The more cyclicals, the industrials that are outperforming, some of the financials. Does any of that stuff come even close to, is it growth in general, number one?
Well, in terms of good earnings growth across the board, value is actually expected to do fairly well in 2024. Value is expected to show a 15% earnings growth rate this year and a 13.5% in 2025. Growth actually is expected to show an 8% decline this year and then squeeze out a 6% growth in 2025. So really the valuations, the PE ratios are stretched, in my opinion. Technology has a 25% relative PE premium over the last 20 years and is trading at a 65% premium currently to its own absolute 20-year average PE. So really, we've got to hit the ball out of the park, in my opinion, to maintain support for the growth area.
Okay, I'm surprised by those numbers that the growth category has negative trailing and then a meager forward. I mean, some of these semiconductors do have negative trailing, but they've got massive forward. Is your growth value definition, where do the semiconductors fit in there in particular, Sam? Are some of them going into the value cohort?
Well, this is the data that's coming from S&P Capital IQ consensus estimates. And the growth consists not only of semiconductors, but also a variety of groups within technology, within consumer discretionary, within industrials, et cetera. So you would have a lot of moving parts that could be dragging down these numbers. And in value, also industrials, but also financials, utilities, consumer staples, et cetera. So companies that are likely to be showing an improvement because of easier comparisons.
Wow. Okay, so it sounds like then, according to the kind of S&P approach, the value trade looks pretty compelling. If it's the value factor from a valuation standpoint and it's got growth, then maybe there's a reason for this rotation.
Absolutely. Well, I mean, if you take a look at the mid-cap stocks, they're trading right now at a 30% discount to their average 20-year relative PE versus the 500. Small caps are at a 31% discount. That's down from 35% just a week or so ago. So there's a lot of attractiveness in the mid and small cap arena. I think investors were just waiting more on confirmation that they seem to get from a dovish Fed Chair Powell, as well as from the CPI numbers. And that could be reinforced if we end up with even softer PCE numbers on Friday.
All right. Good context and good analysis. Always like the historical perspective. You've always got a nugget for us. And, of course, knowing all the earnings stuff off the top of your head. Appreciate it, Sam.
All right. Always good to talk to you. Bye.
Likewise, Sam Stovall, Chief Investment Strategist at CFRA.